Hello everyone, this is Joey from Phillip Nova. I will facilitate the webinar today. Thanks for everyone tuning in on time. Let's give 3 more minutes for some registrants to tune in. The webinar will start at 7:03 sharp. Hello everyone, welcome to the last webinar of the year. Today's webinar topic is ETF ready to roll into 2024. We all know that ETFs have come a long way and there is an increasing number of investors are recognizing that ETFs are an important tool not to be missed in their investment portfolio. Fixed income ETFs have long been an important staple in investors' portfolios, offering the potential for the steady income and relatively low volatility. What are some of the trends that are driving ETF growth in the next year? You are going to hear about our analyst Danish about some promising ETFs that you might want to keep an eye on. Before we kickstart on, just let me to do a little bit introduction on the company. This year is the Phillip Nova's 40th anniversary. Probably this name is a little bit new to you. Actually, we're already in the financial industry with over 40 years of experiences. Uh, we are the rebranded from the Phillip Futures to Phillip Nova in the last 2 years, and then we have plenty of the exciting promotions to celebrate this milestone, which is the 40th anniversary with you. If you are not a Phillip Nova client yet, open an account with us in December. You can get the 250 Marina Bay Sands voucher in December. You can scan the QR code to know more information. And if you are the Phillip Nova clients already, here is the promotion for you. To celebrate our 40th anniversary, we will conducting the final lucky draw during the December to January period with 40 winners per draw. And then you can trade any products in this period and then to get a chance to win the iPhone 15 and more. If you are interested, can scan the QR code and then to get more information. I think coming back to our topic again, let me just do a little bit introduction of today's speaker. And then Danish is an investment analyst with Phillip Nova. His areas of expertise are in equities, indices, forex, and commodities. He frequently shares his views and opinions through daily market commentaries that are sent to the customers. And Danish is also a well-versed in technical analysis. His market views and commentaries are regularly published in the Business Times, 联合早报, and The Age Singapore. Danish finished his business administration degree with Latin honors from SIMGE University at Buffalo. Okay, let me pass the time to Danish. Danish, your turn.
Hello everyone. I hope you guys are able to see my slide. And right now, welcome to today's webinar. My name is Danish, and I'm an investment analyst from Phillip Nova. And the main topic of discussion today will be about ETFs. So before we proceed, just a short disclaimer. This presentation is intended for general circulation and educational purposes only, and it does not constitute as actual investment advice because we do not take into account your specific investment objectives, financial situation, or your particular needs. So this is an outline of today's webinar. I'll start by sharing some of the biggest highlights in the ETF market in 2023, as well as some of the trends that are driving the growth of ETF as an investment tool. Next, I'll share some basic concepts about fixed income or bond ETFs. And I think it's really important for investors to understand how you can use bond ETFs as part of your investment strategy. And if you are able to really grasp the nuances of bond investing, I believe that your investment game will definitely receive an upgrade. And afterwards, I'll also share our 2024 investment outlook as well as some of our strategic calls. So to kick things off, what are ETFs? ETFs are also known as exchange traded funds. They are essentially a type of pooled investment security where they will pool investors' money and then they'll use that money to buy and hold multiple underlying assets. It could be stocks or it could be bonds. And they typically aim to track or replicate the performance of a specific benchmark index, such as the S&P 500. They are also purchased or sold on a stock exchange, just like regular stocks. So this makes ETFs a very convenient investment product. And investors are essentially investing in a very wide basket of securities with just one single trade. And what are some of the highlights of the ETF market in 2023? Data as of the 1st of December shows that global ETF assets reached about 10.8 trillion US dollars. And estimates right now suggest that global ETF assets could reach 14 trillion US dollars by the end of next year. So there's still a lot of room to grow for the ETF industry. And if you were to see this table over here, you can see that the three largest ETFs are actually ETFs that track the S&P 500. So what about the US ETF industry? If you were to rank them based on their year-to-date inflow, which basically tells us how much money investors are pumping into each specific ETF. The higher the inflow, it basically means that investors are buying more of this specific ETF. Quite surprisingly, you see that 2 out of the top 5 US ETFs are actually bond ETFs. And this may come as quite a surprise because we frequently only hear about equity or S&P 500 ETFs in the news or on market headlines. But there's a very important reason behind this. And this is why I feel it's very important for us to understand why investors right now in this current point in time are buying bond ETFs. So moving on to the next section, what are some of the biggest trends driving ETF growth? One of the major reasons is because ETFs provide a lot of advantages, such as they provide investors with simplicity as well as a form of passive investing. Investors can save on a lot of time because they don't need to do single stock picking. And when I say single stock picking, it essentially refers to the having to go through the manual process of reading companies' annual reports, reading financial statements, analyzing financial ratios, and other things of that nature. So all of these are things that are very time consuming. And for ETF investors, you don't need to worry about any of this because at the end of the day, your ETF will match or replicate your benchmark index performance. So there's less of a need to constantly monitor your positions. And for newer investors especially, this means that there's a lower barrier of entry. You don't need very deep or very complex financial knowledge to become an ETF investor. And more recently, there's also a shift towards passive investing. Investors nowadays, they are more willing to accept market returns rather than outright trying to beat the stock market. ETFs also provide a form of diversification as well as an ease of access to more exotic markets. When you invest in an ETF, you are essentially reducing your company's specific risk because you gain exposure to a basket of stocks. So let's say you buy an ETF which tracks the S&P 500, but if one company were to go bankrupt, the remaining 499 stocks will somewhat help to offset the impact that the bankrupt company will have on your investment portfolio. Other than that, ETFs also provide investors with easy access to profitable markets that are traditionally very difficult to reach. So, as an example, what if I were to tell you that there's actually a stock market out there, outside of the US, that has doubled the performance of the S&P 500? And that stock market is actually the Greek stock market. And this may come as quite a surprise, but it's actually returned about 41% year to date. And historically, the Greek stock market is actually a very difficult market to access because it's considered a high-risk jurisdiction. However, if you were to buy an ETF, and if you were to use this Global X MSCI Greece ETF, you can very easily, gain exposure to this to the entire Greek stock market with just one single trade. What are the other trends? ETFs are also cost effective and they provide liquidity. When you buy an ETF, you are essentially investing in a wide basket of securities with one transaction. And this means that you will incur fewer broker commissions than if you were to buy stocks individually. And they also provide liquidity. Investors are able to very quickly move in and out of different sectors and markets. And perhaps a more interesting trend is institutional adoption. More recently, we are seeing that institutional investors, they are increasingly embracing ETFs due to their low cost, liquidity, and transparency. So really, this mainstream acceptance of ETFs, even among the biggest financial institutions, is probably one of the biggest trend or one of the biggest reason that is pushing and driving the growth of ETF. For example, even Singapore's Temasek Holdings recently added 3 new ETF positions based on their latest 13F filings. You can see in this screenshot over here, they added new positions in a Brazil ETF, in a South Korea ETF, and even a metals and mining ETF. So this tells us that ETFs, they aren't only for beginners. Even Bank of America's portfolio has, includes ETFs. They have a value ETF, they have a growth ETF. So these two ETFs, they are actually among the top 5 largest positions inside Bank of America's portfolio. Moving on to the very next section, I'll start talking and sharing some very important concepts when it comes to bond investing. And bond investing, I'm fairly confident, is an area where not many people are quite familiar with. So firstly, how do bonds work? Typically, this involves 2 parties, a bond investor, which refers to us, as well as a bond issuer, which typically refers to a government or a company. So when you buy a bond, what you're essentially doing is that you're lending capital or you're lending money to a bond issuer. And this amount that you lend is also referred to as the face value, the par value, or the principal amount. And in exchange for lending this money, the bond issuer will pay you regular interest at regular intervals in the form of coupon payments. And once the bond reaches the end of its life, or once the bond matures, investors will essentially get back their initial investment as well as the accumulated coupon payments. And to put it very simply, when you buy a stock, you're basically betting that the company's sales or the company's revenue or their business will continue to grow. But when it comes to bond investing, you're betting that the bond issuer will be able to repay their debt obligations. And in exchange for taking on that risk, the bond issuer will reward you with regular income payments. So what are some of the important bond characteristics? The first and probably the most important concept to understand about bonds is this concept of interest rate risk. It's the fact or the relationship where bond prices will move inversely to interest rates. So for example, let's say the Federal Reserve, they cut interest rates by 1%. What we will see is that bond prices will go up by 1% or more. So I understand that this concept initially is probably pretty confusing and pretty hard to understand, but I'll try my best to explain it. So the first way or the first explanation is to look at things mathematically. How do we calculate the prices of a bond? Typically, what we do is that we add up the present value of all the coupon payments that we receive, as well as the present value of our initial investment. It can be calculated with this formula over here. And something important to understand is that C, the symbol C, which essentially symbolizes our coupon payments. The coupon payments, when we buy a bond, it's fixed. The coupon payments that we receive doesn't change unless we go out and then we buy another bond. What changes is the market interest rates. And the market interest rates, which is symbolized by R, it represents the discount rate that we used to discount the cash flows to their present value. So when you think of it mathematically, let's say the market interest rates of the Federal Reserve, they raise interest rates. And if R increases while the coupon payments remains the same, what ends up happening is that you'll get a lower present value for your coupons and a lower present value for your face value. So this is a mathematical explanation, but I myself also think that it's pretty difficult to understand. So perhaps a simpler analogy would be to think of an iPhone. And let's say that an iPhone, and as well as its features, their features symbolize their coupon payments. So initially, when you buy an iPhone, at that particular point in time, their features could be very attractive. However, once a new iPhone is released onto the market with newer and more attractive features, your existing iPhone and their features become outdated. And what happens is that your older iPhone, the value of your older iPhone drops. And when you try to sell it maybe to the second-hand market, you will be unable to command a higher price. And this analogy works when it comes to bond prices and interest rates. When interest rates increase, newer bonds with higher interest rates or higher coupon payments will be released on the market. And then older bonds with lower coupon payments will become less attractive, which is why their prices will drop. So I hope you guys understand this concept. It's probably the most important concept when you want to invest in bonds. If you guys have any question, do feel free to just leave your questions in the Q&A, and I'll address it in the Q&A session later on. So what other bond characteristics are there to know? There's also the concept of a credit rating, which basically tells us the risk of default of the bond issuer. When a bond issuer defaults, what it means is that they are unable to pay back their debt. And as an investor, you may end up losing a part or all of your original investment, as well as any interest that the bond issuer owes you. And the higher credit ratings typically belong to government bonds, such as the Singapore government bonds. They have a AAA credit rating, but on the lower end of the scale, we usually call them high yield bonds or junk bonds. So they have a higher risk of defaults. There's a greater risk that the bond issuer will be unable to pay the interest payments, but instead, investors, they get rewarded with a higher yield. The coupon payments that a lower credit rated bond provides is higher. And moving on to the next concept is the concept of maturity. It's basically just the date where you will receive all your interest payments as well as your principal amounts. Typically, what we see is that a longer maturity bond, it's viewed to be riskier because as an investor, you're essentially locking in your money for a longer period of time. And over a longer period of time, you could see a lot more events happening. For example, over 20 years, you could see maybe 2 recessions occurring. But let's say you were to buy a shorter maturity bond, which expires in 3 months, there's a very low likelihood that a recession will happen. So because longer maturities are viewed to be riskier, they will typically pay a higher yield, which means that their coupon payments are higher. So we usually categorize them into 4 different maturity categories. For bonds with maturities less than 1 year, we usually call them ultra short term or treasury bills. For bonds with maturities ranging from 1 to 5 years, we call them short-term bonds, and those ranging from 5 to 10 years, we call them intermediate-term bonds. For bonds with maturity 10 years or more, we call them long-term bonds. And again, it's important to understand that the shorter-term bonds, they are less risky, but they pay a lower yield. But for the longer-term bonds, they are viewed to be a riskier investment. So in order to compensate investors for taking on the additional risk, they will pay you a higher coupon payments. And the last concept is the concept of duration. It is basically a measure of the sensitivity of the change in the bond price to the change in interest rates. And to put it very simply, if interest rates fall by 1%, a bond with a higher duration will rise by more than 1%. And generally, what we see is that bonds with longer maturities have higher durations. So now let's try to guess the impact of rate cuts. Which bond ETF over here do you think will benefit more from the Federal Reserve cutting interest rates? I'll just probably give you guys about 3 seconds. So if you guys were to answer the 20+ year Treasury Bond ETF or TLT, you're right. And the main reason, again, is because it is a longer maturity bond. It's a 20+ year Treasury Bond ETF, which means it has a higher duration, while the SGOV bond ETF, it is a lower maturity. It expires, most of the bonds they hold expires within 3 months. So what we may see happening, for example, let's say the Federal Reserve, they cut interest rates by 1%. What we could see play out is that the TLT bond ETF may rise by, let's say, 1.8%. However, the shorter maturity bond may still, they may still see a rally, but to a shorter magnitude or to a smaller magnitude. So while the TLT may go up by 1.9%, the shorter maturity one may only rally by maybe about 1.3%. So now, of course, I can already see some of you asking, why should I buy bond ETFs? Why can't I just buy bonds directly from the government? And the answer is, of course you can, but buying bonds directly is usually a very troublesome process. So let's say you want to buy Singapore Treasury bills or SGS bonds. They are typically not traded on exchanges, but you have to access them via internet banking with one of the 3 local banks, OCBC, UOB, or DBS. However, the complicated process is that you are required to bid for the treasury bill through an auction process. This may be the first time some of you guys heard of this auction process. And how it works is that upon the announcement date, investors have up until the auction date to submit a bid for the treasury bill. And usually the deadline is on 12 p.m. on the auction date itself. Now, a lot of this information is available on the MAS website, and usually they'll give a list of the different treasury bills as well as the different dates as well. So there's a very strict timeline you have to follow if you want to buy treasury bills directly. And perhaps the bigger problem is that when you buy a treasury bill, there's no certainty on the yield that you receive, because at the end, all bids that you make, you'll receive the same cutoff yield. So when you take a look at this screenshot on the right, this is the result of a June auction for the Singapore Treasury bill. And how this auction process works is that typically the MAS, they will issue a very limited number of treasury bills. So there's a very limited supply. And from this screenshot, you can see that they basically only issued about $5 billion worth of treasury bills. But most of the time, what we see is that the demand is much higher than supply. You can see this from the total amount applied, which is at $9.8 billion. And whether you receive your, the yield or whether you receive the treasury bill depends on the type of bid that you make. There's a non-competitive bid where you specify the amount that you want to invest, but not the yield. So let's say you want to invest in $100 worth of treasury bill, and that's what you will, that's what you actually specify when you make a bid. And for most of the time, for non-competitive bids, MAS will give you priority. And most of the time, what we see is that 100% of non-competitive applications will receive their treasury bills. But the risk is that you have no control over the yield that you receive. On the other hand, you can make a competitive bid where you specify or you state the yield that you want to receive. But there's a risk that you will not be allocated any treasury bills if the yield that you want to receive is higher than the cut-off yield. And this cut-off yield is determined by market supply and demand dynamics. So again, this is a very complex process. If I were to explain more of the process, it'll probably take maybe about 20 or 30 more minutes. If you guys have any question, do feel free to leave, type down your questions, and I'll try to answer it in the Q&A. So what about US Treasuries? You can buy US Treasuries, but you have to open a Treasury Direct account. And to do so, you actually need a US tax ID number or a social security number. So you have to apply for it directly with the US IRS, and you also need a US bank account in order to receive coupon payments. So again, it's a very complex and very tedious process. However, if you were to just use or buy bond ETFs, you can see that it's a lot more straightforward and a lot more easier, a lot more convenient for you to access bonds of different maturities. You can simply buy access US Treasury bills of 3 months, 12-month US Treasury bills, and all of them you can access with just one trade, just like if you were to buy or sell a normal stock. So again, bond ETFs, they really make this whole process of bond investing a lot more convenient and straightforward. Now to summarize, again, the very big and important concept is the inverse relationship between bond prices and interest rates. If interest rates go up, bond prices will drop. Other than that, longer maturity bonds, they are more sensitive to interest rate fluctuations. So a 20-year treasury bond, they will benefit or they'll see a larger rally if the Fed were to cut interest rates compared to a shorter maturity bond. Lastly, as I've mentioned, bond ETFs make the whole process of investing in bonds a lot more straightforward. So now moving on to our investment outlook and strategic calls for 2024. Let's first reflect back on some major events in 2023, starting off with the implosion of the Silicon Valley Bank in March. And at that point in time, there were a lot of fears that it could result in a widespread financial crisis. Of course, this didn't happen. And somewhere towards the middle of the year, we actually saw an AI euphoria. AI-related shares such as NVIDIA started rallying to all-time highs, mainly because of all the hype surrounding ChatGPT. Towards the third quarter of this year, we started to see this higher for longer interest rates narrative started to weigh on the markets. And this eventually led to about 3 consecutive quarters of declines in the stock market. And during this period of time, what we saw was that a group of 7 stocks, including NVIDIA, Tesla, Amazon, they started to have a very big influence on the market. They have literally driven about 75% of the S&P 500's gains year to date. And collectively, they hold about a 28% weight in the S&P 500, and they make up almost half of the NASDAQ. So again, these 7 stocks, they have a very big impact on the market, and it's very important for us to monitor how these 7 stocks move going forward and into 2024. Things started to change, however, in 2024. In November. Wall Street actually broke a 3-month losing streak. November was actually the best month for equities since July 2022. And historically, it's the second best November since 1980. And the main reason is because investors started to expect a Goldilocks scenario or a soft landing scenario where the Federal Reserve will be able to bring down inflation without triggering a recession. You can see in this chart over here that the number of times the specific word recession was mentioned in all forms of media, it could be social media, it could be Twitter, it could be Facebook, and any forms of media. The number of times recession was found in the media actually peaked somewhere at the start of this year, where recession fears were probably at its highest. And fast forward to today, we can see that it's actually declined by quite a large amount. So what's happening in markets right now is that investors, they are pricing out a recession and pricing in a soft landing scenario. And the reason why investors are doing so is because we have seen that inflation data, as they appear to have peaked since June 2022. And at the same time, we also see signs of a very resilient economy. The third quarter GDP data of about 5.2% is actually the strongest since the fourth quarter of 2021. So again, disinflation as well as a resilient economy somewhat making investors believe that a soft landing is possible. More recently, very strong labor market data further reinforced this soft landing expectation. Non-farm payrolls came in higher than expected last Friday, and more importantly, the unemployment rate actually dropped to about 3.7%. And what this did was that it basically convinced investors that a recession, at least in the early half of 2024, isn't very likely. So right now, the markets are expecting interest rate cuts to come in May 2024. And perhaps a more important event will be the Federal Reserve's final interest rate decision of the year later tonight at 3 a.m. It's a key event to watch, and they are widely expected to leave interest rates unchanged for the third straight meeting. And however, we expect Fed Chair Jerome Powell to maintain a tightening bias, as well as push back against expectations of a rate cut. Perhaps more attention should be placed on the updated December dot plot. This is something that investors should monitor. And for those of you unfamiliar with a dot plot, what it tells us is it essentially tells us where the FOMC members, where they project interest rates to be at the end of certain years. So how do you read this chart? For example, when you look at the x-axis of this chart, what it tells us is it basically tells us where interest rates are projected to be at the end of a year. So for example, the 2023 reading essentially just tells us where the Federal Reserve members, where they think interest rates will be at the end of 2023. So you can see from the September dot plot that the Fed actually expects one more rate hike this year. But as we all know, this isn't very likely. And they also expect one rate cut next year. But again, things have changed a lot since September. So it's important for us to monitor, how much the Federal Reserve has changed in terms of their thinking and mindset towards interest rates. So our outlook for the economy can be summarized with, we think that it's too early to declare victory, be it on a recession or be it on inflation. And we summarize our economic outlook based on 5 key points. Firstly, we expect to see a very bumpy and uneven disinflation that will come at a gradual pace. Just last night, we saw CPI data came out which showed that although inflation is on a downtrend, it still remains quite far away from the Fed's 2% target. Their main target is that they want core inflation, which excludes food and energy, to hit about 2%. So again, this tells us that it could take longer than expected for the Federal Reserve to bring down inflation to 2%. The next key point will be, we think that the market right now is being premature when it comes to expecting rate cuts, because we really haven't seen enough inflation deceleration that sort of justifies their rate cut expectations in the first half of 2024. And we believe that unless a recession happens, the Fed will be more likely to start cutting interest rates in the second half of next year. So there's a couple of reasons. Firstly, because the labor market remains very strong. And this is something that Fed Chair Jerome Powell has alluded to a couple of times. And the main fear is that a very strong labor market means that labor demand is still very high. And when labor demand is high, this means that wages are high as well. And the fear is that higher wages in the economy can cause businesses to raise the prices of their goods and services. And higher prices of goods and services could end up pushing up inflation. And this is what we call the wage price spiral. So it's something to monitor going forward as well. Other than that, there's also a fear that if the Fed were to cut interest rates prematurely, it could result in a re-acceleration of inflation. Back in the 1970s, the Fed actually prematurely cut interest rates. And what ended up happening was that inflation actually re-accelerated to an all-time high of 14.8%. And you know that's a pretty crazy number. It peaked at 14.8% in March 1980. And then what this resulted in was that the Fed had to hike interest rates even higher to an all-time high of 20%. That's almost 4 times as high as interest rates right now. So this is something the Fed likely wants to avoid, which is why we think that it's still too early to declare victory on inflation. And ultimately, we think that unless a recession occurs, rate cuts will only come in the second half of next year. What are other key points that we have? We expect to see a positive but slowing economic growth, but we do not expect a recession. And this slowdown in the economy will be driven by a cooling in consumer spending as households and consumers revert back to their pre-pandemic spending and saving patterns. And in turn, what ends up happening is that this will have a negative impact on corporate profits as well as stock prices. So, so far, the economy is being propped up by very strong consumer spending. The consumer makes up about 70% of GDP. And most of this spending is on the services sector of the economy. Services includes things like travel, hotels, food and beverages, and other things of that nature. So spending on this service, service side of the economy remains very strong, but this has come at the cost of higher and higher credit card debt, as you can see in this chart over here. And sooner or later, we believe that the consumers, they will have to start pulling back their spending and focus on paying down their existing credit card debt. More recently, we also see that a lot of consumers, they're starting to rely more on buy now and pay later options. In Singapore, we also have a buy now pay later option called Atome. I'm not sure if you guys are familiar with such a payment service. And this really tells us that consumers right now, they are really stretching their budgets, which is a bad sign of the health of the consumer. Other than that, consumers, their excess savings that they build up have also been drawn down. You can see on this chart that when it comes to their household savings, for the bottom 40% of households, their current household savings, it's well below pre-COVID levels. It's about 90% of pre-COVID levels. And even for the middle 40% of households, their household savings are also below the pre-pandemic levels. So what this means is that consumers and households, they are saving less, but they are spending more. And such a thing isn't a very healthy indication of the health of consumer spending. So we expect consumption and spending to slow down, and this will impact stock prices. We've also seen a lot of warnings from retail giants like Walmart and Target. They actually cut their fourth quarter forecasts, mainly because they said that the consumer is becoming more cost conscious and they are putting back on their spending on some discretionary items. So lastly, we believe that although the risk of a recession has reduced, it has not entirely disappeared. And looking into 2024, the biggest question will be why the Federal Reserve cuts interest rates. Because the reason for rate cuts is also very important. And let's say the Federal Reserve, they cut interest rates because inflation has come down sufficiently enough, inflation has reached their 2% target. And we also see a very strong economy, so it's a soft landing scenario. And in such a scenario, it's actually very good news for investors. We are likely to see higher corporate profits and consequently higher stock prices. However, if the Fed were to cut interest rates when due to a slump or due to an economic recession, this is bad news because corporate profits may take a hit due to demand destruction. And when corporate profits take a hit, this may result in a decline in stock prices. So the reason for rate cuts is also very important as we move into 2024. And ideally, you want rate cuts to happen because inflation has cooled sufficiently enough, not because the economy is in a recession. Because if the economy is in a recession, it will have a very bad impact on the stock market. And this is why for our 2024 investment outlook, we actually advocate for cautious optimism. And although markets are, expecting a soft landing, we are actually quite skeptical of one because historical data from 1965 to 2022 shows that it has only happened once out of 11 tightening cycles. And that was back in 1994 to 1995 under Alan Greenspan. Another big factor will be the lagged impact or the fact that monetary policy acts with long and variable lags. Academic studies have estimated this lag to range from 1 year to 2.5 years. So this means that right now at this juncture, we may have yet to feel the full impact of rate hikes. And at the same time, although the data is still very strong, it's actually been on a downtrend. If you were to see this chart over here, the orange line represents the S&P 500, while the light blue line, it represents the economic surprise index. And what it measures, it essentially measures how much economic data is beating estimates. And if this blue line, or if the economic surprise index sees a rally, what it means is that economic data in the US, they are surprising more and more to the upside. However, roughly since the end of October, we see that the economic surprise index has been on quite a sharp downtrend. And this tells us that economic data is becoming weaker and weaker. And we think that this is a bad medium-term omen for stocks. It could be a sign of some bad things to come for the stock market. And when we do a scenario analysis, we see three possible scenarios. And all three scenarios, the Fed will cut interest rates for different reasons. Our base case remains an economic slowdown in the first half of 2024. And in such a scenario, when the economy slows down in the first half, we expect the Federal Reserve to react to economic weakness and then cut interest rates in the second half. In such a scenario, we expect to see a moderate downside for stocks, but bonds will still outperform. And the reason that bonds will outperform is because of the inverse relationship between bond prices and interest rates. Recall that I mentioned that when interest rates drop, bond prices will increase. And this is why I said that that concept is very, very important when it comes to bond investing. Right now, however, the soft landing scenario, the green boxes over here, it probably most closely aligns to the current stock market prices. And in such a scenario, the Fed can proactively cut interest rates as long as inflation comes down enough. They can cut interest rates probably earlier in the first half, and this is probably the best scenario for stocks. Although we are likely to see bonds also benefit from rate cuts. The worst case scenario will be a hard landing or a recession, and the Fed will have to cut interest rates very urgently in order to rescue the economy. This is probably the worst scenario for stocks, but we still expect bonds to outperform, thanks to the inverse relationship between bond prices and interest rates. And the key takeaway here is that in all three scenarios, bonds will benefit from interest rate cuts. And this is why we think that the risk reward for bonds is actually more attractive than the equity markets. So again, our 2024 outlook, we expect a slowdown in the first half and a recovery in the second half. And the current stock market pricing means that they will really have to hit that soft landing scenario in order to justify their sky-high valuations. And given how high stocks have moved, we believe that risks are tilted or they are leaning towards the downside. Lastly, regardless of whether a recession happens or not, the risk reward for bonds looks better than equities because as long as rate cuts happen, bonds will outperform equities. The prices of bonds will start to rise whenever interest rates drop. So what are the investment implications of this view? Firstly, from a tactical perspective, we expect a slowdown, but this does not mean we see a recession happening. But at the same time, this does not mean that we should just blindly chase after stocks and just not be balanced in our investment decisions. Because the direction of the stock market is harder to predict, at least compared to bonds. If we see a soft landing, stock markets will benefit. But in the opposite scenario of a recession, stocks will suffer. Therefore, we have more confidence on fixed income or bonds because we believe that the Fed, they will cut interest rates at some point next year, even if in either a soft or a hard landing. And for these reasons, we actually favor a 40-60 stocks to bonds portfolio. And in such a portfolio, we basically increase our exposure to bonds and we favor it over stocks. And this will provide us with diversification as well as balance. Bonds can also be used to diversify against a recession. In a recession, although we are likely to see stock prices drop, in a recession, the Federal Reserve, they are very likely to cut interest rates. And this is where we will see bonds start to outperform stocks. So for bonds, we prefer medium and long duration bonds. And this includes ETFs like the iShares 20+ year treasury bond ETF. Again, we prefer them because they are more sensitive to interest rate fluctuations. They only focus on bonds with maturities that are more than 10 years. And we also like the 7 to 10 year treasury bond ETF. You can see that they focus on bonds that have a maturity ranging from 7 to 10 years. Lastly, if you're still very confused about the whole concept of the inverse relationship between bond prices and interest rates, as well as the whole concept of duration, you can very simply just take a look at this Vanguard Total Bond Market ETF. And what it provides you is that it provides you with a very wide exposure to bonds, all of different maturities. So it's basically the investment product or the bond ETF that you look for when you just want to keep things simple. On the equity side of things, we actually prefer a barbell approach because, at least in our opinion, we think that the current stock market valuations, they reflect a very unlikely soft landing scenario. But at the same time, there will definitely be pockets of growth opportunities in specific sectors, such as artificial intelligence, such as EVs. And what this barbell strategy does is that it allows us to strike a balance between risk and reward on opposite ends of the risk spectrum. For those of you unfamiliar with the barbell strategy, what this strategy involves is that you essentially just focus your investment only on the higher risk stocks as well as on the lower risk stocks, while at the same time you completely avoid any stocks that you think come with moderate risk. And what this does is that it helps us capture profitable opportunities in the higher risk area of the market, such as AI, EVs, or some of the more disruptive themes out there. So although traditionally when you expose yourself to these higher risk areas, you are likely to incur higher risk. But with this strategy, you are essentially able to balance out that additional risk with your exposure to the lower risk area of the market. So for the defensive half of this strategy, these are some of the sectors that we like. It includes bond proxies, such as the utilities sector. The utility sector, we usually call it to be very similar to bonds because they are a very safe sector and they usually pay investors regular dividend payments. There are also other sectors such as the aerospace and defense that can be used as a geopolitical hedge, as well as quality factor ETFs. And these ETFs, they only target very high quality companies with very strong business models, with comparative advantages and very strong financials. And lastly, we also like Singapore REITs because they provide regular income and they also benefit from interest rate cuts as well. For the growth half of the portfolio, we like disruptive themes such as artificial intelligence, as well as more little known the GLP-1 weight loss drugs. For those of you who are unaware, stocks related to this drug, they have actually rallied year to date by about 60% or more. And what this drug does is that it basically mimics or it attempts to replicate the GLP-1. And GLP-1 is a hormone that our body naturally produces. It essentially tells our brain that we are feeling full. We have eaten enough, and that our body is full. And this helps people who consume this drug. It helps them regulate their appetite as well as helps them with weight loss. Other than that, we also see very attractive opportunities in other countries such as Japan, as well as South Korea. South Korea actually has a lot of semiconductor companies such as Samsung as well as SK Hynix. And the key thing to take away here is that we believe ETFs will really help you simplify the entire process of implementing a barbell approach. You can very easily just gain exposure to an entire sector or an entire theme, such as the AI theme. And you can do so with just one trade because ETFs, they essentially function just like stocks. So these are some examples of ETFs that are on our watch list. And we will most likely, we favor this couple of ETFs when it comes to implementing a barbell strategy. Now, some of you guys who are listening to this presentation, you guys may have more questions, especially when it comes to the specific sectors, the specific ETFs of the equity side of the market. However, unfortunately, this is actually outside the scope of this webinar. If you guys want to find out more, I believe there's another webinar where we will dive deeper into the stock market on the 10th of January next year. So do feel free to drop by. It's on the 10th of January. And if you guys want to find out more about equity investing specifically, you guys can attend. So these are some of the ETFs that are on our watch list. So now that we've come to the last section of this webinar. So what are some of the biggest or the key takeaways from this webinar? Firstly, again, it's the very, very important concept of bond investing, the inverse relationship between bond prices as well as interest rates. When interest rates go up, bond prices will drop. Other than that, bond ETFs, they also make the entire process of bond investing much more convenient. Recall back to the very troublesome process of bidding for your treasury bills, and as well as opening a treasury direct account if you want to buy US treasury bills. So bond ETFs make this entire bond investing process a lot more straightforward as well. And another takeaway will be that, at least in our opinion, we think that the risk reward of equities look worse than bonds because the direction of the stock market is very hard to predict. If a soft landing happens, that's good. But if a recession happens, that's very, very bad news for investors. Lastly, we have more confidence on the fixed income and bond side of the market because regardless of whether a soft landing or a recession happens, the Fed is very likely to cut interest rates sometime next year. And because of the inverse relationship between interest rates and bond prices, whenever the Fed cuts interest rates, the prices of bonds will start to go up. So for some of our technical views, we prefer a 40-60 stocks to bonds portfolio in order to gain more exposure to the bond market. For bonds, we prefer medium and long duration bonds due to their rate cut sensitivity. And these are 3 examples of bond ETFs that are on our watch list. For the equity side of things, we see a still challenging outlook in the first half of 2024, but we expect to see disinflation as well as rate cuts in the second half to support a stock market recovery. And we prefer a barbell strategy where we focus our investments only on the high risk area of the market and the low risk area of the market. And at the same time, we avoid the sort of middle area or stocks, or we avoid stocks with moderate amount of risk. And to conclude, we believe that ETFs, they will become the dominant investment tool of the 21st century. we expect to see the first Bitcoin and Ethereum ETFs in 2024. And this will further widen the ETF investor base because we are likely to see some spillover from crypto investors. They are likely to spill over into the ETF industry. And lastly, I believe that moving forward, we'll start to see ETFs being used as a tool for investors to make very quick portfolio adjustments to rapidly changing market backdrops. And again, this is why we actually prefer using ETFs when it comes to implementing the barbell strategy. It's very easy, or it's a lot easier to switch your exposure between different sectors with just ETFs. And with that, we've come to the end of today's webinar. I hope you learned something new today. If you guys have any questions, feel free to contact me via our email or my office number. And now we'll move on to the Q&A session, where I'll pass the time over to Joey.
Hey, Danish, I think thanks for your comprehensive analysis and also the forecast of the market outlook. There are one questions about in bond ETFs. I think Mr. Ling is asking, can we use SRS or CPF-OA to invest in bond ETFs?
For bond ETFs, I think I think that depends on the broker. But most of the time, if you want to buy bonds directly, you can use SRS or CPF. So I'm not sure about the answer to that question, but I think that it's quite likely that you're able to as well.
Okay, thank you. I think the second question is more related to bond ETFs as well. The investor is interested in the interest rate risk. What kind of interest rate risk that as an individual investor will be facing next year, and what kind of interest rate trend is going to happen next year?
So when we talk about interest rate risk, especially for bonds, what it means is that there's a risk that if the Federal Reserve, let's say tonight, let's say they actually surprised the entire market and they hike interest rates by 25 basis points, there's a risk to the bond market that these higher interest rates will cause bond prices to drop. And this is the main risk that bond investors face. Whenever interest rates get higher, the bond investors will suffer. And moving into 2024, this expectation or the trajectory of the US interest rates will play a very large role when it comes to the fate of bond investors.
Hey, Danish, thanks for answering this question. We come to the last question of today's webinar, which is what kind of other determinators for the bond ETFs, the price to drop or increase, other than the interest rate? I believe this is the follow-up question that's coming, followed by the question that you just answered.
So other than the interest rate risk, something that is probably lesser known is that affects bond prices will be the type of bonds as well. There's different type of bonds. There's corporate bonds. There's also municipal bonds. Municipal bonds are actually rarer. What they are that they are bonds that are issued by state governments. So in the US, for example, we have bonds that are issued by let's say the state of New York or the state of San Francisco. And what actually may impact stock prices will be the state of, or will be the health of specific states in the US. So let's say, for example, that the New York or San Francisco, they start to see, the housing crisis start to get worse. So what happens is that this a worsening housing crisis, or where housing prices continue to go up and people are unable to get houses, and what ends up happening is that investors' sentiment towards a lot of these municipal bonds will also get worse. And although it may not be directly related, what we sometimes end up seeing is that the municipal bonds of the specific state prices of them also start to drop.
Okay, Danish, thank you for answering all the questions. Let me just take over and then to have a closing on my side. Thanks for everyone to tuning in today, and then hope you guys have a little bit more knowledge about what is the market trend for the next year and what kind of ETFs that you should get into investment portfolios. And then if you are interested in Danish's webinar, you can also tune into the phillipnova.com.sg to look for the stocks webinar on 10th of January. It will be also conducted by Danish. And then if you are more interested in the stocks, you can have a listening to that as well. And just a recap that this year is Phillip Nova's 40th anniversary, and then we have been in the industry for 40 years till this year, and then you can have a very exciting welcome gift for you in December when you open a trading account with us, which is the 250 Marina Bay Sands voucher. You can scan the QR code to learn more and then get more information about how you can get a voucher. And also, if you are already a client with Phillip Nova, here is the promotion for you. We are going to conduct the final lucky draw from December to January. Uh, we each time will have 40 winners per draw, and then you can trade any product during this period to be eligible and then unlock the iPhone 15 and more. If you are more interested in this promotion, and then you can also scan the QR code to learn more. Thank you, everyone. Thank you, Danish. Hope that you guys have a good Christmas ahead and also the new year ahead. See you next year. Bye bye, everyone.